All right, listener, ready to shatter some money myths. We all hear them, those so-called financial truths that get passed around like ancient wisdom. But today we're separating fact from fiction with expert insights to help you make smarter money moves. Expert speaker, I've got our listeners' stack of sources here, and some of these myths are pretty juicy.
I know, right? It's amazing how these misconceptions persist even in the age of information. But that's why we're here to equip our listener with the knowledge to make informed decisions about their finances.
Absolutely. So let's dive right in. This first one is a classic. You need to be rich to start investing. It's like this invisible barrier that keeps so many people from even trying.
It's a shame because that's just not true anymore. Technology has completely democratized investing. You don't need a fortune to get started. You can literally begin with pocket change.
Really? I mean, I've heard of those micro-investing apps, but I always assumed they were more for rounding up spare change. Can you actually build a decent portfolio that way?
You absolutely can. It's not just about the initial investment, it's about the power of consistency and, as we'll talk about later, compound interest. Think of it like this. Instead of trying to time the market or make big bets, you're steadily building wealth over time, brick by brick.
Okay, that makes a lot of sense. So even if I'm not dropping thousands of dollars on stocks, I can still get the ball rolling. What are some of the options out there for people who want to start small?
There are so many. Micro investing apps are a great entry point, but you also have fractional shares, which let you buy portions of individual stocks. This means you can invest in companies you believe in, even if their share prices seem intimidating.
Fractional shares, that's interesting. Is it like owning a sliver of the company then? Do I get voting rights and all that?
Well, voting rights depend on the company and the brokerage, but the main idea is that you participate in the stock's growth proportionally to your ownership. It's like owning a slice of a very valuable pie.
So even someone just starting out can potentially own a tiny piece of, say, Amazon or Apple.
Exactly. It removes the barrier of entry and makes investing much more accessible. And the beauty of it is you can start small and gradually increase your contributions as your income grows.
Okay, I'm definitely feeling more empowered already. Let's move on to another myth that seems to circulate a lot, particularly among older generations. Carrying a credit card balance is good for your credit score. This is one I've always been skeptical about, but I know people swear by it.
It's understandable why this myth persists. Credit scoring can seem mysterious and counterintuitive, but carrying a balance actually works against you.
Wait, really? So my grandma has been giving me bad advice all these years. She always said that showing you can handle debt makes you look more responsible.
Unfortunately, that's a misconception. What really matters is your credit utilization ratio. Think of it like this. Lenders want to see that you're using credit responsibly, not maxing out your cards and struggling to make payments.
Okay, so explain this credit utilization thing like I'm a financial newbie. What exactly does it mean, and how does it affect my score?
Imagine your total available credit across all your cards is a pie. Your credit utilization is the percentage of that pie you're currently using. The smaller the slice, the better.
So if I have a $10,000 credit limit and I'm only using $2,000, my utilization is 20%. And that's a good thing.
Exactly. Ideally, you want to keep it below 30%. A lower utilization shows lenders you're not overly reliant on credit and managing your debt well. It signals that you're a lower risk, which translates to a better credit score.
That makes so much sense. So it's not about carrying a balance. It's about showing that you have access to credit but aren't using it all up.
Precisely. It's about demonstrating responsible credit management, which is key to building a strong financial foundation.
Okay, this is all making so much more sense now. Let's tackle another big one that I've personally heard countless times. Renting is just throwing money away. As someone who rents, this one always gets under my skin a bit.
It's a common misconception, often fueled by the cultural emphasis on homeownership. But the truth is, renting has its own set of financial advantages, and it's not as simple as throwing money away.
Okay, but what about building equity? Isn't that a huge benefit of owning a home? You're paying into something that's yours, right?
Absolutely. Building equity is a significant advantage of homeownership. But it's important to remember that owning a home also comes with a whole slew of additional expenses that renters don't have to worry about.
Like what? Give me the nitty-gritty details.
Well, you have property taxes, which can be substantial depending on where you live. Then there's homeowners insurance, maintenance and repairs, and potentially even HOA fees if you're in a condo or a planned community. These costs can add up quickly and eat into your potential equity gains.
So even though you're building equity, You're also shelling out a lot more on a monthly basis.
Exactly. And that's not even considering the initial down payment, closing costs, and the potential for unexpected expenses like a leaky roof or a broken furnace.
So when does renting actually make more sense financially than buying?
That's a great question, and it really depends on your individual circumstances and financial goals. If you're not planning to stay in one place for a long time, for example, the transaction costs of buying and selling a home can outweigh the benefits of building equity.
What about situations where home prices are just insanely high?
That's another key factor. In some markets, renting might actually be more affordable than buying even in the long run. It allows you to allocate your funds towards other financial goals like investing or saving for retirement without being burdened by the high costs of homeownership.
All right, so it's not as black and white as some people make it seem. There are definitely situations where renting can be the smarter financial move.
Absolutely. It's all about assessing your individual needs, your financial situation, and your long-term goals. There's no one-size-fits-all answer when it comes to renting versus buying.
Okay, listener, I hope you're starting to see that these money myths aren't as straightforward as they might seem. We're going to take a quick break, but don't go anywhere. We've got plenty more myths to bust and insights to uncover.
Welcome back to the deep dive. We're knee-deep in debunking money myths, and I'm already feeling lighter like I've shed some financial baggage. What's next on the myth-busting agenda?
Let's talk about a myth that has a bit of historical glamour to it. Gold is always a safe investment. You know, pictures of those gold bars stacked in vaults, always seeming to hold their value. Yeah, gold has that aura of stability, like it's immune to economic ups and downs. I'm guessing it's not quite that simple, though.
You're right to be skeptical. While gold can act as a hedge against inflation, meaning it tends to hold its purchasing power when prices are rising, it's not a guaranteed win. It's still a commodity, and its price fluctuates based on supply and demand, just like oil or coffee beans.
Okay, so gold isn't this magical, always goes up asset. But what about the idea that it's a safe haven during times of crisis? Don't people flock to gold when the economy gets shaky?
They do, and there's some logic to that. When there's uncertainty, people seek assets they perceive as stable. But here's the thing. Gold doesn't generate income like stocks that pay dividends or bonds that offer interest. Its value is tied to its perceived worth, which can be volatile.
So someone who put all their money in gold could actually lose out if the market shifts in a way they didn't anticipate.
Exactly. That's why diversification is so important. Instead of putting all your eggs in one basket, you spread your investments across different asset classes, each with its own risk and return profile. Gold can be a part of a diversified portfolio, but it shouldn't be the only player.
That makes a lot of sense. It's like that old saying, don't put all your eggs in one basket. Speaking of spreading things out, let's talk about a myth that often gets pushed on young adults. You need to buy a house to build wealth. It's almost like a societal pressure cooker, right?
It's definitely presented as the cornerstone of the American dream, but it's not the only path to wealth creation. In fact, for some, it can even be a financial burden.
I think a lot of people see home ownership as this tangible sign of success, like you've made it once you have a mortgage. But it sounds like there are other potentially better options out there.
Absolutely. The stock market, for instance, offers the potential for higher returns over the long term, even factoring in market fluctuations. Then you have entrepreneurship. Starting a business can be risky, but the rewards can be immense, both financially and personally.
Okay, so starting a business is one option. What about for those of us who aren't quite ready to take on the entrepreneurial roller coaster?
Even something as simple as consistently saving and managing your money wisely can put you on the path to financial security. It's about developing good financial habits, living below your means, and making your money work for you.
So it's not just about owning a house or starting a business. It's about making informed choices about where your money goes and how you can grow it over time.
Precisely. Homeownership can be a great investment for some, but it's not the only way to build wealth. It's important to consider your personal circumstances, your risk tolerance, and your long-term financial goals.
This next myth kind of makes me cringe because I think it stops people from even trying. It's too late to start saving for retirement. Is there any truth to that? Is there a point of no return?
The good news is it's never too late to start. Yes, the magic of compound interest works best when you start early, but that doesn't mean you should give up if you're starting a bit later in the game.
But what about people who are, say, in their 40s or 50s
Yeah.
and haven't been diligently saving? They must feel like they've missed the boat, right?
While starting earlier is always better, the key is to take action now. There are ways to catch up, like increasing your contributions to retirement accounts or exploring different investment options with potentially higher returns.
So even if someone's been procrastinating on their retirement planning, there's still hope.
Absolutely. It's about creating a plan, adjusting your budget, and seeking professional guidance if needed. There are financial advisors who specialize in helping people get their retirement savings on track no matter their age or current financial situation.
Okay, that's reassuring. Let's tackle a myth that I think a lot of people tell themselves, almost like a self-fulfilling prophecy. I'm just bad with money. It's almost like they've given up before they've even started.
It's easy to feel overwhelmed or intimidated by personal finance, but here's the truth. Managing your money is a skill that can be learned just like cooking or playing an instrument.
I love that. So instead of saying, I'm bad with money, it's more accurate to say, I haven't developed those skills yet.
Exactly. And there are so many resources available today to help you build those skills. You have books, podcasts, online courses, financial advisors, even free budgeting apps. It's all about taking that first step and not being afraid to ask for help.
So where's a good place to start for someone who feels completely lost in the world of personal finance?
I always recommend starting with the basics. Create a budget to track your income and expenses. Identify areas where you might be overspending. Set small, achievable financial goals. Once you have a clear picture of your current financial situation, you can start making informed decisions about how to manage your money.
Okay, I'm feeling more motivated already.
Yeah.
It's all about taking control and believing in your ability to learn and grow.
Exactly. Financial literacy is a journey, not a destination. It's about continually learning, adapting, and making choices that align with your values and goals.
All right, let's move on to a myth that I think perpetuates a lot of fear and misunderstanding. Investing is just gambling. It's almost like people see the stock market as a casino where you're just rolling the dice and hoping for the best.
While there's always an element of risk involved in investing, it's fundamentally different from gambling. Gambling is based purely on chance, whereas investing involves research, analysis, and a long-term perspective.
So when I buy a stock, I'm not just throwing darts at a board and hoping something sticks.
Not quite. Smart investing is about understanding the fundamentals of a company, its financial performance, its position in the market, and its growth potential. It's about making informed decisions based on available information, not on gut feeling or blind luck.
Okay, so it's about calculated risks, not just wild speculation. But how do you manage that risk? I think a lot of people get scared off by the idea of losing money.
Risk management is a key part of investing. Diversification, which we talked about earlier, is crucial. Spreading your investments across different asset classes helps to mitigate losses. You also want to have a clear investment strategy that aligns with your risk tolerance and time horizon.
So investing isn't about trying to get rich quick. It's about a long-term approach to building wealth.
Exactly. It's about making your money work for you over time, allowing it to grow and compound, and hopefully reaching your financial goals down the road.
Okay, I'm getting a much clearer picture of how investing actually works. Now, let's talk about a topic that's been making headlines for the past few years: cryptocurrency. Is it really the future of money? Will we all be using Bitcoin to buy groceries someday?
Cryptocurrency is definitely a disruptive force in the financial world, but whether it will completely replace traditional currencies is still up for debate. There are definitely exciting possibilities, but also challenges to overcome.
What are some of the hurdles that cryptocurrency faces?
One of the biggest challenges is volatility. The value of cryptocurrencies can fluctuate wildly, which makes them risky investments for the average person. There are also regulatory uncertainties and security concerns, as we've seen with some high-profile hacks and scams.
So it's important to approach crypto with caution and do your research before jumping in.
Absolutely. It's essential to understand the risks involved as well as the potential rewards. It's also important to choose reputable exchanges and wallets to store your crypto assets securely.
Right, good advice for anyone curious about the world of crypto. Before we wrap up this segment, I want to address one more myth that can be really damaging. You have to be rich to be financially secure. This one feels especially relevant in today's economic climate, where so many people are struggling to make ends meet.
It's easy to fall into the trap of comparing ourselves to others and thinking that financial security is only attainable for the wealthy. But the truth is, financial security is not just about how much money you have. It's about having a plan, managing your resources wisely, and living within your means.
So someone who earns a modest income can still achieve financial security.
Absolutely. It's about making smart choices regardless of your income level. It's about prioritizing your needs, saving consistently, and avoiding unnecessary debt.
So financial security is more about mindset and habits than it is about your bank balance.
Exactly. It's about taking control of your finances, building good financial habits, and making informed decisions that support your goals and values.
Okay, listener, I hope you're starting to see that financial well-being is within reach for everyone. It's not about how much you earn, it's about how you manage what you have. We'll be back after a short break to continue our myth-busting adventure. Stay tuned.
We're back and ready to tackle the final few money myths in our listeners' deep dive. I don't know about you, expert speaker, but I'm already feeling a lot more confident about my own financial decisions after busting all these misconceptions.
Me too. It's amazing how much power these myths hold over us until we really examine them. Knowledge is definitely the antidote to financial fear and uncertainty.
All right, let's jump right in. This next myth is one that I think resonates with a lot of young people. I don't need to worry about retirement. That's years away. It feels like something you can just put on the back burner and deal with later, right?
It's tempting to think that way, especially when you're young and have so many other immediate priorities. But the truth is, time is your biggest ally when it comes to retirement savings. The earlier you start, the more you benefit from the power of compounding. We've talked about compound interest before, but can you break it down again for our listener, specifically in the context of retirement? Why is starting early so crucial?
Imagine you invest a small amount of money today. Over time, that money earns interest. But here's the key. The interest you earn also starts earning interest. It's like a snowball rolling downhill, gathering more and more snow as it goes. The longer that snowball rolls, the bigger it gets.
Okay, so even if I'm only putting away a small amount each month, the fact that I'm starting early gives my money more time to grow exponentially.
Exactly. And those early contributions can have a dramatic impact on your final nest egg. It's not just about how much you save, it's about how long that money has to compound.
All right, I'm starting to see why they call compound interest the eighth wonder of the world. Let's move on to a myth that I think holds a lot of people back from investing. Investing is too complicated for me. It can feel intimidating, especially with all the jargon and different options out there.
It's true that the world of investing can seem overwhelming at first. But the good news is, it's not rocket science. You don't need to be a financial expert to get started.
So where should a complete beginner start? What are some baby steps they can take to dip their toes into the investing pool?
The first step is education. There are so many resources available today, from books and podcasts to online courses and even robo-advisors that can help you get started. Start by learning the basics of investing, like different asset classes, risk tolerance, and diversification.
And remember, you don't have to go it alone. There are financial advisors who can help you create a personalized investment plan and answer any questions you have along the way.
Absolutely. Seeking professional guidance can be invaluable, especially if you're feeling overwhelmed or unsure where to begin. A good financial advisor can help you set realistic goals, develop a sound investment strategy, and stay on track over the long term.
Okay, one last myth for the road, and this one is a bit philosophical. Money can't buy happiness. I think we've all heard this one at some point in our lives.
It's a well-intentioned saying, and there's definitely truth to it. Money alone won't solve all of life's problems or guarantee happiness, but it's not the whole story.
I think sometimes this myth gets used to dismiss the importance of financial well-being, like it's somehow shallow to care about money. But wouldn't you agree that having financial stability can reduce a lot of stress and anxiety?
Absolutely. Financial stress is a major source of unhappiness for many people. Having a secure financial foundation allows you to focus on other aspects of your life, like your relationships, your passions, and your personal growth.
So while money may not buy happiness directly, it can create an environment where happiness is more likely to flourish.
Exactly. It's about finding a balance, using money as a tool to support your values and create a life that is meaningful and fulfilling.
Well, listener, we've reached the end of our deep dive into money myths. I hope you're walking away with a sense of empowerment and clarity. Remember, knowledge is power, and the more you understand about personal finance, the better equipped you'll be to make informed decisions and build a secure future.
It's been a pleasure joining you on this journey, and I encourage our listener to continue exploring these topics, asking questions, and challenging the conventional wisdom about money.
And here's a final thought to ponder as you go about your day. If you could invest in anything with no limits, what would it be? And more importantly, why? We'd love to hear your ideas. Share them with us on social media. Until next time, keep diving deeper and stay